So I think we'll have some fun here in the next hour. You heard our backgrounds. My first bullet here was to have us introduce ourselves. You've already met Josh and heard a little bit about Joe and my background. I'll give you 30 more seconds on mine, ask Joe to do the same. My firm, HIG, is actually, in many ways, very similar to Prism, in some ways very different. My fund, HIG Bioventures, is a venture capital fund that focuses exclusively on healthcare and in particular therapeutic drugs and devices and a little bit on diagnostics, no healthcare IT, very little life science tools, for example. But my firm, HIG Capital, manages about $8 billion across a lot of different asset classes that Josh talked about, like leveraged buyout. We have a real estate fund. We have a hedge fund. I personally have really very little to do with those, but I get exposed to some of the other asset classes, and healthcare is probably our single biggest sector that we invest in across all those different asset classes. So, Joe, if I could just ask you to maybe give 30 seconds on what you actually do at that small little company in New Jersey that you work for.
Yeah, Johnson & Johnson. So we're a big company. We're actually about 255 operating companies, about 120,000 people, 57 countries, revenues of about $65 billion a year. Watchword would be decentralized, which means that sovereign entities within the organization are really the operating companies. The central structures are relatively modest, and I'm in one of those central structures. I'm responsible really for looking at those technologies, platforms that don't yet reside within Johnson & Johnson, parts of the healthcare continuum in which we do not yet fully engage, and looking at the technologies rather early on. And so oftentimes, a handful of folks involved in something that may even be pre-commercial, pre-company even, and finding a way to create a home, finding either a way of accelerating them on the outside or internalizing them on the inside in a way that's good for both them and for us, and ultimately for the patients.
Thanks, Joe. I want to use this time really to your benefit, of course, so I'll try to keep it a little bit informal. We'll leave time at the end for questions, but in these panel formats, I'm a big fan of having Q&A insert itself wherever it's appropriate. So if we're talking about a topic that you have a question on, give me a little signal, and I may not call on you right away unless you're interrupting Joe, in which case I'll call on you instantaneously. But let's try to keep this a little bit interactive because this is really your time to get what you want out of the three of us. I've got some questions here that I'll use to get our group going, but please feel free to, and I'll try to pause a few times in the middle to see if we have any questions, but I'll get it going and then we'll see where it goes. And let me start with a tricky question, particularly given the economic situation we're in. And Greg grabbed me right before the panel and said, maybe it'd be interesting to talk a little bit about how things are different today than they were even 2 years ago or even 18 months ago. I don't know how you mark time. I mark time based on the day Lehman fell apart. Which was, for the venture capital industry, in my view, the day the world changed. We were all kind of bumping along in the middle part of 2008 thinking things were bad, but not that bad. And then when the government let Lehman go, I think we all that was our, oh crap moment. But so the way I'd like to phrase it, we've talked a lot about entrepreneurship, starting companies, raising money, two really, I thought, very insightful talks this morning. But let's get very granular on starting a business. Let me first ask you guys, how many people in the audience, as we sit here today, have either started a business or could say with 90% certainty they're going to start a business in the next couple of years? That's great. That's a lot of hands. So let me ask, I'll start with you, Joe. If you're thinking about starting a business, so you're practicing clinical medicine today, you're thinking about a couple of ideas, is now a good time to do it?
So I'll tell you first, he was nice enough to send me the questions in advance yesterday, giving me the potential for a time to prepare. And this is a difficult question, but I think the answer has always been the same. Independent of the external environment, it's always been a question of whether or not that's your passion. And I don't say that blithely. I think it is always a difficult decision to either stop what you have been doing or take on something that's going to be consumptive of your time and your resources. But if it's truly your passion to get this done, I don't know that the external environment should weigh so heavily on that decision. I think if if it's something you feel you need to do, if there's an unmet need that you believe you have unique visibility to or unique skill sets to solve, and you really feel that that's a big aspect of what you can bring, then I think you have to go do it. I think the notion of no, I'm not going to go do that, that just seems unacceptable. So I'd say, even though the question is poised in terms of, is it the best time? I think if your passion tells you got to go do it, then you do have to go do it. It may be more difficult, but I don't think we're all here because we ever chose the easiest path. I think we chose that which was going to have the most value.
Josh, you painted a picture for us with respect to the innovation economy that I think was at the very least cause for concern or paying attention if you weren't concerned. And by the way, I agree with your comments on that, and it concerns me for sure. What do you think? Is this, if you're advising a close friend who's saying, I'm going to go start a business, do you say, do it now, or do you say, let's wait and see how some of this stuff shakes out?
I think what I was referring to is more around macro conditions, and it's hard to apply macroeconomic condition to a specific circumstances. Macroeconomics will tell you generally what's going to happen, and in general, I mean, in hedge fund parlance, there'll always be the beta, and you have to find your alpha, right? Market conditions will always be what market conditions will be, and you can't control that, and you generally can't foresee that. The question is, do you have an idea that you think is good enough that you'll beat the market? Because good ideas, one way or the other, it'll always be concerns about how you structure capital and raise money and make your company look. But within reason, good ideas generally will find a way of prevailing and at least beating the market. It certainly is tough times, and I think going to get tougher for innovation in generally. But saying that means that there's not going to be any innovation would and that good ideas have no place to go would certainly be overboard. So, to Joe's point, if it's your passion, go for it, and you'll find a way to succeed.
So I think I would tend to agree with you. But what do we do differently? So if I was and I'm thinking about some of my own portfolio companies where you said it earlier, sort of the head scratcher, where everything's gone really well, and yet things aren't going that well, and you kind of go, why is that happening? We've got a company in our portfolio, medical device company that has, when they started the year calendar year 2009, the plan was to get 4 products approved by FDA and launch at least 2 of them. And I looked at that plan and went, yeah, right. And you know what? They got the 4th one approved last week, and they're launching product, and it's going great in a big market, and they've had trouble raising venture money. And I kind of think of that. I go, why? And I think part of the answer is the market got squirrely. It's a tough time to raise money. So, and I've told the CEO in his moments of despair, by the way, I talked to him last night. He said, you're in Vegas? Well, instead of putting the money in our company, why don't you put it on red, and whatever you win, we'll put that in the company. So, I don't think my investors would like that. But what would your advice be to a guy like that, or to somebody could be that guy in 2010? How are you going to approach it differently? If he had raised money in 2007 for this company, I'm 99% convinced it would have been a 3-month process with multiple VC term sheets at competing valuations. And here in 2009, he's having trouble getting 1 or 2. So what do you do differently in this market environment if you're an entrepreneur and you need to raise capital in particular?
I think there's so one thing I think that happened in venture and entrepreneurship generally is, and this is partly what's a big piece of this to blame, is that massive influx of venture capital. Is too much money went into these companies, and companies got over fat and lazy. And it's a very bad thing for companies to have, for startup companies to have too much money, because they'll find a way to spend it and they'll never make it back. So in some ways, we've gone way overboard, but in some ways, at least what was happening until Lehman fell, I think, was clarifying, because you were washing out some of the fat, and companies were forced to be a lot leaner and really do what a startup company is supposed to do. What do you do now with these economic risks? I mean, we're seeing all. I mean, maybe this is outside the scope of this talk, but we're seeing all. Partnering earlier. Doing option deal. Things to keep the company going that maybe gives up some of your constrains your options, gives up some of your upside, but is really good for Joe.
Well, let me ask something specific to Joe on that, because we've seen this in our portfolio. I'm guessing, Joe, you've seen it in your business, is as the total venture dollars available has shrunk. There's absolutely no question about that. And frankly, we haven't seen the half of it yet, because venture funds have, you saw this in one of Josh's slides, we have essentially 10-year lifetimes. So a fund that was raised in 2007, when times were pretty good for raising venture funds, that money's probably only about half invested. I mean, I'm using averages. So if you raised $1 billion fund in 2007, you probably have $500 million of it left to invest. When that's finished, which would be in about another year or two, that $1 billion fund is not going to raise $1 billion for the next fund. They're going to raise something less than that, maybe zero. So I think and I don't mean to be too pessimistic, because I think good venture funds will survive and raise capital. I'm praying, because I'm raising a new fund right now. But Joe, we're seeing a lot of our portfolio companies, and we're advising a lot of our portfolio companies to look at strategic interactions with big companies like yours that do have cash on the balance sheet to invest, to partner, to do strategic things with, not only because it's good for the company to get close to big companies that might someday acquire them, but because they've got money. Are you seeing a dramatically increased influx of small companies coming to you for capital? Do you have enough capital to support them? How much bigger a role are guys like you going to play in financing little companies going forward?
Great question. We have, for the last couple of years, been preparing to play more of a role. We have different mechanisms for engagement now for smaller companies. We will, and I'll get into a little bit of this tomorrow, but we will sometimes engage to keep efforts alive or to spur them toward proof of principle, proof of concepts. Oftentimes with non-dilutive financing, with non-debt financing, it often looks like gifts and grants, even though it's, for us, not scientific philanthropy at all. It's getting closer to the management team, getting closer to the idea. We do in-kind contributions. We hook them up with people who've been in that area for a while that are internal to the company. We can do material transfers to give them reagents and bits and pieces to move their project along. We have a clear vested interest in making sure that these opportunities persist to stay viable. But it's not all, it's not all roses and chocolate on this side of the fence either, because the global economic scenarios that have impacted everyone have certainly impacted the large players as well. And so while the valuations for some of the opportunities at the moment are more attractive, we still have to build in the development budgets going forward. And as it's leaner in all of the operating companies, the notion of going to an operating company and say, hey, there's this really cool thing that's directly adjacent to what you guys already do, and we think it's really a bargain right now. And they say, yeah, but I'm going to need development dollars in 2010, 2011 for this project. I'm not sure I'm going to have those. So that acquisition in the moment, which is a real bargain, may be not the best thing for the company on the outside, because they get brought into a large firm and then that project may be deprioritized. And so sometimes the strategy for us is to keep things alive on the outside, as opposed to internalizing our